All right, so let's get started. Just want to say good morning, everyone, and welcome everyone, and thank you all for joining us today. We are excited to have you. I just want to start by saying thank you for this webinar will be recorded. I would like to introduce you all to our speakers, Justin and Sam and Nancy. She won't be speaking, but she is here with us. They're all from National Life Group. They are here to give us some valuable information on everything they offer here at National Life Group about their annuities and their IULs. Um, Please join me in welcoming Justin and Sam. You guys, the floor is all yours.
Sounds great. Thanks, Shakita, and thanks everybody for joining us. I know on a Friday it's hard to join a webinar and that, but I promise you, you're going to make some money by working with the products and the ideas that we share today. So I'm super excited to be here along with Nancy and Sam. Um, a couple of different things. I mean, for those of you who don't know National Life, I'm going to tell you it's the best company that a lot of people haven't heard of, right? It's a 176-year-old company, second oldest life insurance company in the United States. That's pretty amazing, but we have the number one IUL product out there. Plus, we're number one in the flexible premium space with retirement plans. So as you dig deeper and as we go through the ideas and the sales opportunities here, I think you'll find you take a look at us. So my ask at the end is to work with the network insurance team and ultimately, take a look at the illustrations. And as we're going through the presentation today, jot down a client name. If you think this product can help your client, jot their name down real quick and put a note on it, right? Because that's how you're going to drive revenue. And that's really what we're trying to do is to help you drive revenue, make more money, right? And so, with that in mind, and Sam just reminded me, we're actually the number 7 company overall in insurance sales. I mean, it's pretty amazing. So, with that, I'm the annuity person at National Life. We have a new team working with network insurance across the country. We have 3 annuity wholesalers, 3 life insurance wholesalers. Nancy's on the eastern region. Sam and I cover the western region. We have Eric, who you'll see next week in Florida at the meeting. He covers the eastern region for annuities, and then Craig and Anthony cover the central region for annuities and life as well. But I like stories, everybody. And if you see my bookcase behind me, I have all my little gimmicky story things, right? My candy jar, my unicorn, and that. And I want to talk about a unicorn. So when you take a look at retirement planning, if you asked your clients what they would like with a retirement product, I'm going to guess they're going to say these 3 things, right? First off, make me a lot of money, right? Everybody with their own retirement plan, they want to make a lot of money. Second thing is don't lose my money, right? It's like, think about that. It's like we want to make a lot of money. We don't want to lose any money. What would the third thing be? They really don't want to pay us, right? They don't want any cost coming out of the product at all. And if you take a look at it, if you have a product that can make a lot of money, make sure people don't lose money, and you don't have any fees, well, that's a unicorn product, right? Well, that's what we have with fixed index annuities today, because think about it. You get the upside potential. I'm going to talk about a 34% story for upside potential. You don't have any fees unless you elect to take the fees, right? So income riders, no income riders, booster rates, no booster rates. You don't have to have any fees. And the best thing is that we're protecting against the clients from losing money. And that's pretty good for those people looking at retirement planning today, because if you take a look at baby boomers, what have they done? They've shifted from aggressive portfolios with a lot of stocks into bonds, and bonds just haven't been performing for you. In fact, if you take a look at the US aggregate bond index over the last 5 years, it's down 17%. 17% on bond portfolio, and people think bonds are safe, right? Well, if you're taking that income out, you're actually locking in those losses. And we have the stories to help you where you don't have to worry about what's happening with the market, what's happening with the cost, and ultimately the index annuity stories can work pretty well. So let me pull up here. Let me pull up my slideshow, my presentation. And at National Life, we have a couple of different footnotes. So we'll send you this presentation afterwards too. And in fact, I know Shakita already has it, but I want you to write down three different numbers. So if everybody can bear with me, write down three numbers: 10%, 25%, and 34%. We're going to talk about how that can help your clients grow their money, how it can protect an income stream for them, and give them greater upside potential. So at National Life Group, we have annuities for all needs here. In fact, when you take a look at your customers, you probably have these customers in your book of business, right? You have people that are looking to save for retirement. They may be 10, 15, 20 years away from retiring. We're going to go and talk about a client just like that. Those planning for retirement, those are the people that are getting nearer retirement, right? So they may be within 5 to 10 years of retirement. Well, they may have different needs. It may be switching from accumulation to income. Those starting retirement, that's usually protection or income planning opportunities. So think about these clients in your book of business. How many people are saving for retirement? How many are planning for retirement or just starting retirement? And then you have that last group, and that's usually 62 and older, where they just want that peace of mind in retirement. They want that unicorn product where they aren't going to lose any money. And frankly, that's what we can help them do with the annuities at National Life Group. So if we just dive in and take a look at Steve, the short timer, this is my 10% story. In fact, you know, we have a product. Steve's 7 years from retirement. He's done okay, saved $100,000 in his savings account, right? He's actually looking for a bonus product to move his money into, and then he's going to start taking withdrawals periodically. Well, our growth driver product offers a premium bonus for you. So the growth driver 7, it's a 7-year surrender charge schedule. It offers a 7% premium bonus when you move the money in, and it goes to work for you right away. So ultimately, the $100,000 goes to $107,000 right away for your client. And this product offers strong potential interest crediting, has 2-year crediting options as well. Plus, it has some peace of mind features, right? A nursing care rider, terminal illness rider. So, that's approved in most states. And those are ways that if Steve needed some extra money, if he was in a nursing home or was diagnosed with a terminal illness, we would waive the surrender charges on the contract. So it can really help clients have access to money. But remember, this isn't an income rider product. He's just taking a look at taking withdrawals from it. And frankly, those bonuses can help. So they go to work for you right away. So whether it's $25,000, which is our minimum, or $100,000, or even $500,000, think about that. You could get a 7% bonus or a 10% bonus. Now, who else might this help? How many clients have you worked with over the past 5 years that maybe their interest rates when they purchased an annuity, they were lower at the time, right? Or maybe a client isn't happy with the product they purchased, and because the crediting rates, the renewal rates have continually gone down and down and down. Well, this bonus can help you make up that surrender charge in the product. And frankly, at National Life Group, we're pretty flexible. Show the economic benefit of making the move from their existing product into the growth driver product and taking advantage of that bonus. And if we show an economic benefit that the rates are just higher and it just makes more sense for the client to do it, well, you can do that and use this product to move it. So if you have any questions, call me, shoot me an email, or call anybody else on our team, and we can give you kind of a quick review to see if we think it's going to pass our compliance review. But everybody, we've seen some pretty high surrender charges getting moved into this product, just because it makes more sense. If the crediting rate's 8% and they're currently at a 4 or 5% rate, let's use the bonus, make up the surrender charge, or use that bonus to get them ahead even further. So, you know, when we take a look at Steve, the short saver here, that is definitely something that can help him. Plus, for those people worried about the market, because I mean, just right now with the political things happening politically, the market doesn't like uncertainty, and we're seeing it kind of go up and down. Well, we do have a dollar cost averaging crediting strategy too. So, frankly, you get a fixed account rate that move systematically into the index crediting strategies throughout the course of the year. So definitely an opportunity for you with those people that are, kind of looking at retirement, not necessarily in retirement. But we also have that 25% story. And I want to talk about Carl the clairvoyant. 25% is the income-based bonus that we offer on our income driver 10. So we've talked about the 10%, right? That's a 10% premium bonus. It goes into their cash value. It starts working from day one. The 25% bonus is on the income base. So for you clients that are looking to create an income stream, that 25% can supercharge what their income can be. So Carl's 5 years from retirement. He has $500,000 from an inheritance. He wants lifetime income and to know exactly what his retirement income will be. And everybody, when you take a look at income planning, Social Security, clients know they're going to get Social Security. We usually will use this product to take a look at those essential living expenses, right? So let's make sure the lights are turned on, food's on the table, insurance is paid for, things like that, where you can't have that fluctuation on withdrawals from the market. And remember, I talked about, bond portfolios being down over the last 5 years. That just creates a fluctuation on their income stream. Well, with this is 100% predictable, right? The income driver 10 can give your clients certainty with guaranteed income, and we're still allowing them to grow their cash values. So those same high participation rates that we saw on the growth driver, the 2-year crediting options, the nursing care rider, terminal illness rider, those are all available on this product as well. But we know that people need some help. Maybe they haven't saved enough money. Maybe they bought an old product that hasn't been performing where they thought they were going to get bonuses, but the bonuses haven't worked as you expected them to. This product can throw your clients a safety net, get that 25% bonus. We actually have a 10% simple interest roll up with that charge, guaranteed lifetime income rider, and even the no charge. So if your clients don't want to pay a 1% fee, they won't get the 25% bonus, but they will still get a 10% simple interest roll up. And everybody, on $100,000, that just means we're adding $10,000 each year to the income base for the income calculation. So, ultimately, great way to create that predictability. I know that at age 65, I'm getting 5.65% as that withdrawal rate. So if my 100,000 went up to $200,000 in 10 years, well, that can just help your client. And I want to switch here and share an illustration just real quick. So let me switch this out and go to share my screen and this and the illustration. So let me change this out to not Steve the short timer here, but all right, let me drag it down. Carl the income. All right, so everybody should be seeing the income driver illustration. You'll see right on the cover here, we have 10% roll-up rate with a 25% bonus. We're putting it right out there, right? So what you're telling your clients, automatically they're going to see that right away. We go through, we kind of reaffirm that, right? That they get the choice of multiple crediting strategies. They won't outlive this income base. And by the way, it's like when you take a look at the client concerns, what's the number one client concern? they're afraid of running out of money. This is going to make sure that they're never going to run out of money because the income stream gets paid for as long as they live. What's the number two concern? Well, being a burden on your family. Well, if you're taking those withdrawals from those, the stock portfolio or something, and the market goes down 20%, you still need to take that money out. Guess what happens? That account could dwindle. Same thing with this. The cash value is going to go down, and I want to show you page 11 here. Cash value is going to go down, but even if you run out of cash value, you're still going to have the benefit of the income coming out. So here's the $100,000. You can see that, let me move this over, that my calculation benefit base is $137,000. So what's that mean? I've added the 25% bonus, so that's 100 to 125,000. The 10% roll up is actually based on that 125,000, not the 100,000, right? That's how we get to the 137,500 because we're adding $12,500 each and every year. And remember, Carl was retiring in 5 years. Check this out, everybody. This is awesome, right? $100,000 premium, he's getting $10,594 in income. That's like over 10% of what he put in just 6 years later. And he gets that 10,000, 10,000, 10,000. You can see here, 15 years later, he's taking $158,000 and he's only 79. He turns 80 that year. Think about how many clients you have in your book of business. Think about your relatives and friends and who you might be able to help create $10,000 a year for guaranteed income for your client. To me, that's just amazing, right? You can create that certainty, but you'll see. I mean, as you're taking the money out, that cash value can dwindle. But I'm still, even if I keep going here and go all the way to age 100, I'm taking that $10,594 out. This is truly that unicorn product, right? Create that lifetime income for your clients, create that certainty for them. And if the cash value grows better than what's illustrated, that's awesome. They can always stop this and take that cash value out once they're out of that 10-year surrender charge schedule. You don't have to worry about that. So they can make changes as well. So let me go back here and go into my PowerPoint. So we've talked about the 10% bonus. We've talked about the 25% income-based bonus. Now I need to talk about my 34% story. Well, actually, before I forget, I should probably talk about the income doubler. So everybody, I know you're talking to clients that are probably concerned about long-term care, right? And if you can have a product that gives you multiple benefits to alleviate those concerns, that's just a better solution for your clients. Well, we do offer the income doubler on our income riders. So that the income driver that just went through the $10,000, if the policy's been in force at least 2 years and your clients are unable to perform 2 out of the 6 activities of daily living permanently, we're actually going to double the income for your client, and we're going to double it for up to 5 years or until that cash value is zero. So, the cash value performance, the better it performs, the better this benefit's going to be for your clients, because, we want them to be able to take that up to 5 years if that's what they need. But we're going to go 10,000, turn it into $20,000 for up to 5 years. What happens 6 years later? Well, it just reverts back to that $10,000 if they're still alive. So, the activities of daily living, you can see it on the right-hand side here, but this is a way, and even in California where I'm at, this is approved in California. So, I know Network Insurance has a network across the country. We're happy to share this idea. I know in California and certain other states that a lot of companies don't offer anything to protect against long-term care risks or that 2 of the 6 activities of daily living risk. This can help your client. So, all right. So then now let me talk about my 34% story. And for a lot of people, they just, they might have heard about index annuities. And frankly, they're like, okay, well, they limit my upside potential, right? And there's costs and things on them. That's what they think. Well, no, we get to tell them the unicorn story. And by the way, when I do virtual calls with clients on the line with you, every time I tell the unicorn story, people smile. Well, what happens when they smile? That means they like us, right? And frankly, if they like you, they're probably going to buy from you. So, definitely use that story. But the idea of the upside potential, I mean, Susan the Saver here, she's 15 years from retirement. She has $250,000 from an old 401k. She really just wants to keep her money safe. And there's this kind of misnomer out there that, younger people need to be in the market. Well, I got to tell you, anybody that's afraid of losing money can use this product because it's just helping accumulate funds, and it's that safe money portion of the portfolio, which means it's that CDs, it's the savings accounts, it's the bond alternative. Zenith Growth 10 is just going to deliver because it gives you safety from the market loss. It gives you high upside potential. And in fact, the 2-year crediting based on the S&P 500, that 2-year crediting strategy on the S&P 500 is a 34% cap. Now, this is a booster rate, so there's a 1% fee each year, but I can give your clients up to 34% crediting in a 2-year period of time. Now, I don't know about you, but I think this year, if I was predicting, I think the market's going to keep going up and down because, it's like, with politics and stuff, there have been a lot of things with tariffs and that. People just don't know what's happening. But we do have a sense that the market's going to rebound, right? And it's already started rebounding a little bit, but it's going to rebound next year. So if I asked you what you think the market's going to do over the next 2 years, would anybody give me a number higher than 34%? I haven't heard many people thinking that the market's going to go up more than 34%. Well, the Zenith Growth 10 gives you that 34% upside over a 2-year period of time. And actually, let me just show you how this can work for your client with an illustration. And the illustration will show you that, hey, I can actually get that 34%. So here's my Zenith Growth 10. Let me go to slide 12 here, or page 12 on the illustration, because page 12 shows you what the actual performance would have been for your clients. And so everybody, what I did on this illustration is I put 50% in the 1-year strategy, and that's up to a 10% point-to-point cap rate. On the 2-year, it's up to that 34%. So you can see here, it's like we have 34% getting credited. Well, look at this. The annual effective growth rate is over 20%. And these are all crediting strategies based on the S&P 500. It's actual history. It's not something made up and complicated like a volatility control strategy that you have to explain to your clients. It's just, this is simple. Follow the S&P 500. If the S&P 500 is up 34% or less in the course of a 2-year period of time, your client gets 100% of that. So 100% participation rate, crediting up to the 34%. So everybody, I mean, this is just a great story. The 34% story, here's what I'm talking about, right? The S&P 500, the point-to-point cap, the 2-year strategy. You can see growth driver 10, it's 34% here. So great upside potential for you. I know it's a little bit different, right? But I'll tell you, allocate 50% to the 1-year, 50% to the 2-year, and then after that 1-year period of time, switch it into the 2-year booster rate. That way you have that 34% each alternating years. You get that better upside potential for your clients. And if you don't want that 1% booster fee, that's okay. I mean, 23% is still a great number, and that's our standard rate for that 2-year point to point. So, great opportunities for that upside potential. We know clients aren't happy with bond portfolios because they've seen those negatives when they're taking withdrawals. This is just a new story for you to help those clients out. And ultimately, it's something that can help you drive more business. So everybody, I hope that you've written down at least 5 different clients, right? We've talked about 3 different strategies: 10%, 25%, and 34%. 10% for a premium bonus, 25% for an income-based bonus, 34% growth upside potential over a 2-year period of time. That's our growth driver product with the 10%, the income driver product with the 25%, and the Zenith 10 for the 34%. So, with that, I think that, Sam has some exciting information to share here. I'm right at 30 minutes, Sam, so I'm doing good today. So I'll let you take it over from here. But thanks, everybody.
Thanks, Justin. So, we're going to kind of change directions here. Justin was just talking about the annuity side. Obviously, National Life Group, what we are really known for, and Justin mentioned it, our flagship product is our IUL. So I'm going to be diving into a little bit about our IUL and trying to go over some myths and maybe even discuss or really discuss how it works. So you got a great understanding of how our IUL works, and then hopefully we'll have some time to go over some case studies. So with our IUL, and really its growth has been insane in the time I've been at National Life Group. We've gone from being like a top 20 insurance company in sales to, as Nancy pointed out in the chat, this year we're number 7. So we've seen really just an explosion in growth. And we've done that primarily in the middle market. And it's really no secret for why that is, because the middle market is really there's a need in the middle market, and the middle market is really getting squeezed. If you look at statistics, in the 1970s, a two-family household had about around 40% of their income was discretionary. So from the 1970s, and you fast forward to today, and with it's in the news every day, inflation, about 20% of two-family households' incomes are discretionary. So we see a dramatic shift as the middle market is really getting squeezed in what their ability is to save. On top of that, retirements are really, really changing in the United States. The middle market in the 1970s, about 50% of people working in the middle market had pensions, had access to private pensions. A lot of that was from the industrial sector. If you fast forward to today, 2025, only about 11% of people in the middle market are working for a private company, have a private pension. So we see the middle market and what they have access to getting squeezed. And really, the IUL has become the product that's trying to answer those needs, right? There's a lot of needs, and we're going to go over how the IUL can answer those needs and really help a client have a security net, but also begin planning for retirement. And hopefully we'll be able to get to some case studies that show you just some of the clients we can help you plan for. So I'm going to hop over and share my PowerPoint. Justin, is my screen sharing the PowerPoint? Are you seeing that? Perfect. Thank you, guys. Okay, and got to get through some. Let's play it here. Sorry, guys. So I'm going to make sure it's playing. Oops. And there you go. Is it showing just like the play screen, or is it showing? Okay, perfect, perfect. So gonna jump through these disclosures, make sure everybody's closely reading those. And now we're gonna dive into Flex Life. This is Flex Life. It is an IUL, or our name for the IUL, Flex Life, and it really highlights what an indexed universal life is supposed to be. It's a very flexible product for the middle market because if you look at some of the older life insurance products, they're much more rigid. And just because of that discretionary income change we see in Americans, I think that's why IULs are really helping because their ability to allow you to play flexible premiums. So here's just some more statistics showing you some of the issues that are facing America right now. And one of the big numbers I want to highlight is that 52% of adults already recognize that they need some kind of life insurance and they don't have it. So the great news is, I think in the past, a lot of times people had to go out and show their clients the need for life insurance. But right now, a lot of clients are already recognizing that they need life insurance. So you don't have to go out and create that need. So again, here's our agenda. We're going to be going over Indexed Universal Life, National Life Group's Indexed Universal Life, and then we're going to hopefully have some time for some case studies. So here's a puzzle piece that I think truly encapsulates what National Life Group is offering and how that IUL is becoming becoming the product of choice for the middle market. If you look at the needs people have now, right? Everybody thinks about life insurance as the old school version of life insurance. And what I mean by that is life insurance, when we typically think about it, we just think about a death benefit. But National Life Group offers a product that has so much more than that, right? Part of this puzzle piece, right, is still death benefit. If you die too soon, we definitely need something to protect our families. But there's two other pieces to the puzzle piece that National Life Group is offering. The first is our accelerated benefits. I'm only going to be touching on those briefly, but it's great to know that National Life Group has them. Nancy's going to be covering those a little bit more in depth in our next section. So we have our accelerated benefits. That means you can access your life insurance while you're still alive if you have an illness. Talk about those just a little bit. The second part that makes the IUL so powerful for the middle class is its ability to grow cash value that can be accessed in retirement. And National Life Group takes that one step further. We have a guaranteed income rider that allows you to access that income in retirement and essentially helps you make that IUL become almost like a pension plan. As I just mentioned, pension plans aren't anymore, right? They're not something that the middle class typically has now. Now you're offering a product that can endow, right, or become like a pension plan. When you get to retirement, you can make it give you a guaranteed stream of income in retirement. And National Life Group is the first company to start offering this type of rider on an insurance product. So life insurance, you don't have to die to use. This is NLG's Living Benefits. NLG was the first company to start advertising living benefits. We started promoting this all the way back in the 1920s when the Great Depression was starting to happen, right? We recognized that our clients needed access to cash value. So we started advertising, or we looked for ways to get cash into our clients' hands. And so we came up with this concept of living benefits. These are benefits you don't have to die to use. They come as a rider on all of our products at no extra cost. So if you have a terminal illness, you have a chronic illness, a critical illness, critical injury, we are the only company that has a critical injury rider. Alzheimer's, we're the only company that has an Alzheimer's rider. That means if you get one of these illnesses, we will give you access to your death benefit early. Just to highlight that, we just recently added the Alzheimer's rider, only company to have an Alzheimer's rider. The year we added that, I think it was just last year, in January of last year, the month we added that rider, we had a client put in a claim for Alzheimer's. They had $1 million policy and they were able to get $750,000 because they had been diagnosed with Alzheimer's. So it's a really, really awesome rider that's going to help your clients when they need it the most. They don't have to access their living benefits. We're just giving them options. So think about all your clients that might be in a car accident or might be diagnosed with cancer, right? We give them the option to access their death benefit while they're living, to help them pay their mortgage, to help them pay their car payments, right? So that if they need it, their life insurance can be there for them. So now diving into Flex Life, and hopefully a lot of myths about how IULs work. So hopefully by the time we get done, you'll have a good understanding of how cash values grows in life insurance and how you can position that for your clients that need it. So there's a ton of different products, life insurance products out there. A lot of them you might be familiar with. Some of you might be new to insurance. So when I used to think about insurance before I got into this business, the main product I had in my mind were well, the main two products I knew about were term insurance, which I knew term insurance as a very basic insurance that I thought mostly everybody had, right? If you're a father or recently became a mother, right, you want to have insurance to protect your children. And then I also knew about whole life insurance. And whole life insurance was something I thought like, maybe much older people like my grandparents had whole life insurance. So there's a bunch of different types of products, the oldest of which is whole life. And that's why it's much more common among older people. Whole life has a lot of guarantees, but it's very expensive and very rigid. So it can be a great product if you want a lot of guarantees, so you still see it for that. Whereas term insurance is your most affordable insurance, but it's only set for a term period, right? So not a lot of guarantees because it's not guaranteed past whatever term you've got it for. So it's common to see it in like a 30-year period term, the same amount as like a 30-year mortgage. So you see term often used for mortgage protection. You see whole life used as kind of a legacy play or in trust funds for a place where you need high guarantees. An IUL is something in between, right? It's going to offer a lot of flexibility in payments with a lot of potential in cash growth. Not as many guarantees though. So you can grow more cash, but it's not as guaranteed. It doesn't have the guaranteed on cash growth. So we'll see how that works a little bit here in a second. But it also is going to be much more flexible in how you pay into it than a whole life or a term policy where you're required to pay a set amount of payment. There's going to be a much more flexibility in your IUL. A cool feature I just want to touch on our IUL product before we talk about how it works is the easy underwriting portion. One of the biggest reasons why people don't get insurance is they're scared of needles, right? They think about insurance kind of the old way we used to do insurance. They think they have to go have a paramed or somebody come to their house, poke them with needles, take their medicals and send it off, and then an insurance company decides if you're approved or not. That's not how it works with National Life Group. We have our easy underwriting. So pretty much anybody in the middle class that's looking for a amount of coverage, they're not going to have to go through that. You really just submit an app. So all the underwriting questions are actually in the app. So no paramed actually has to come out and visit with you. So there's a banding on that, right? There could be a paramed need if you get more coverage than you see on your screen. So ages 18 through 50, we go all the way up to $3 million in coverage. Ages 51 through 60, it's $1 million in coverage. And ages 61 through 65, you can get $250,000 of coverage, all without having to get a paramed. Now we're going to dive into how an IUL actually works, the mechanics behind it. I see so much on social media about IULs. I mean, you can find them on TikTok, you can find them on YouTube, but a lot of times there's still just a little bit of mystery about how is my cash going to actually grow in an IUL policy? How can it give me money in retirement? So how does it give you all this upside potential and downside protection? So let's talk about that. What happens with an IUL is you're going to pay your premiums in, premiums are deposited in, fees are taken out, and then the rest of the money goes into an index performance. And we'll talk about the index performance and show you how that can grow. But a lot of people say, well, hey, I'm paying money in. Why is there a cost for fees? Well, the fees are going to cover all that insurance we just talked about, right? You have protection if you die, along with those accelerated living benefits. So you have this premium that you pay in, a portion of it goes to pay for those expenses, to give you that death benefit protection, to give you those accelerated benefits. But then whatever you pay over those fees goes into a bucket of money that's going to grow based on how an index performs. So how do index strategies work? How is your cash value going to grow once it hits that index bucket? How does it start to grow in an IUL? Well, there's a couple different ways or a couple different strategies you can choose, but there's two big terms you need to know when you're looking at index universal life. The first is you need to understand how a cap works. And then the second is you need to understand what a participation value is. So a cap is the most money you can earn based on the index. And then your participation is how much you're going to get of that performance. So two quick examples. Let's say you have a client that has a participant. Oh, let's see. Hold on. I think I had my first example on this screen. So let's say you had a client who was in the S&P 500 and that index increased by 10%. If you had a cap rate of 6%, how much would they earn? Well, if the index increased by 10%, even though it went up all the way by 10%, because you're capped at 6%, that client would have grown by 6%. They would get 6% interest credited on that index or that growth that year. Here's another just quick example to show you a little bit more about how the participation rate works. So let's say that same client was in a strategy that had a cap of 6%, but had a participation rate of 140%. Now, in this case, the index has grown by 4.5%. So how would you calculate how much growth they had? In the last example, the client only got 100% participation. So you didn't really have to multiply or figure out what the participation rate is. You knew they got 6%. With 140% participation, that means you got more, little extra participation. So in this case, you would have to take the growth of the index and times it by the participation rate. So 140% times by 4.5%. In this case, this client would get the same interest credited. So you'd get that 6% interest credited. Now we have a ton of different strategies for your clients to choose from. That's something we can discuss right on individual calls in more details. But I want you to know they're out there. Some of which even include uncapped strategies, so that you could get more than a cap rate of 9% or a cap rate of 10%. They'd be totally uncapped. We even have fixed strategies where your client could say, hey, I think the market's going to be down this year. I want to be in a fixed strategy because I want to know that I'm going to get accredited money. And your client can change that every year based on how they think the market's going to perform. So they're not just locked into one for their whole life. So a lot of different strategies, a lot of cool strategies we have there. We also have a lot of cool riders, and hopefully I'll be able to go. I want to show a couple of ones that I think are the most important here on some of my examples. But to name a few, right, we've got the accelerated benefits. One I hopefully will be able to touch on is the balance sheet rider. And then our charitable matching rider. So charities are a big deal right now. A lot of money is being earmarked for charities. So let me see if I can change over and start highlighting our illustration software. So let's see. Guys. And Justin, are you seeing my illustration software now? Okay, perfect. So I have three quick examples I want to show you guys just to really show you the power of the IUL and really get you thinking about potential clients you could go to, maybe family, friends, and offer an IUL to. So one of the first strategies you can use an IUL for, I would call a mortgage protection type strategy. So here's Danny Tanner. This Danny is 30 years old. He's living in California. He's got a big household, so he's working on a limited budget, and he needs to be able to put money away to cover a mortgage for his house. So he just bought a house. Let's say he bought it maybe before COVID, and he just bought a house for about 250K, and he wants to know if something happens to him, if he's in a car accident, he's got the living benefits to protect him, or if he passes away, he'll be able to leave his family a house free and clear of the mortgage. So he needs about $250,000 of coverage, and he wants to get that as cheap as possible. So I've already gone ahead and designed this case, and we have other trainings where we can walk through in depth how to design it. But I just want to show you how the numbers kind of work and how it would work for Danny if he needed this type of coverage. So he could get Danny, who's 30 years old in pretty good health. He could get about $250,000 of coverage for just $59 a month. So $59.60, that comes out to about $715 dollars a year. Let me see if I can increase the size of this so you guys are seeing it. Hopefully this is a little bit better, guys. So about $715 a month, he could get that coverage. And after he pays in about 20 years, let's see, let me go back. Simplify this a little bit. So after he pays in, 30 years, he would pay about $21,000 into this account, and his cash value would have grown to about $25,000. So he could pay into this IUL for 30 years, and at the end of 30 years, if it grows at a 6% rate, he would be able to get all the money he paid into this IUL back and then some, so a little bit of extra. So he would have been able to cover his mortgage for the life of his mortgage for just roughly $60 a month, and then he's able to get all that money back. Now, the cool thing about an IUL is he doesn't have to choose to take that money at that point, right? If he decides, hey, I want to go ahead and keep this coverage in place, he can. He's given that flexibility. So that's one of the cool things about an IUL. So that's one case I want you to think about all the clients that you think could use a mortgage protection type strategy. Another way an IUL is used is for people thinking about college planning. Now, oftentimes the counter to college planning saving with life insurance or an IUL, you're going to hear something that's really, really popular called a 529 plan. Now, how you position a life insurance versus a 529 plan, because so many people are sold on that, is one of the problems with a 529 plan is you use assets that are known as securities. Now, the problem with securities is they can take big dips. And if you happen to have a kid go to college, let's say in 2009 or 2020, and you have to sell those assets off to pay for college, it can be you selling your assets off at a very large discount. With life insurance, it's a much more stable asset, so that you know, since it's got the floor protection, you know much more accurately how much money you will have. So life insurance can be used to position for college savings. So here we have Laura Ingalls. Her father, Charles Ingalls, wants to start putting away for her college planning. He wants to pay about $500 a month and be able to know how much money he can get for Laura when she decides to go off to college. So a cool thing about life insurance is you don't have to report it on any forms you fill out for college. So with 529 plans, that's not always the case. you could actually not get scholarship money or money from the government because you have a 529 plan. Life insurance, that's not the case. So if Charles pays into this plan, he's going to be able to get at $500 a month. If he waits, so a popular strategy is have Laura go ahead and take out student loans because they're tax-free until Laura graduates. Go ahead, take those loans, and then at the end, when Laura's graduated from college, take money out of the life insurance policy to pay off those loans. So if Charles follows that strategy, he could have about $234,000 to help pay off Laura's loans. The really, really cool thing about life insurance or an IUL is it doesn't stop there. Let's say Laura, after she graduates from college, she wants to go ahead and keep that life insurance policy open. So she just graduated from college. She doesn't have as much money as Charles did to fund it at $500 a month. But let's say Laura funds it at just $200 a month. By the time she reaches 30, 34, she could have as much as $84,000 to take out again out of the IUL to help with a down payment on a house. So you see how this can continue with Laura, unlike a 529 plan. Finally, let's say after Laura buys her house, she doesn't have quite as much income or as much money. She now has a mortgage. So she just wants to fund the IUL at $100 a month. If she does that, by the time she gets to retirement at age 67, 68, she now could start taking out as much as $200,000 a year to help supplement her retirement. So not only did Laura get a death benefit with living benefits, her college paid for, but she's also able to help with a down payment of a house and supplement her retirement. And quickly, I know we're running out of time. Just one last person to think about. This would be a business planning, a middle market business planning situation. Or help me highlight one of our writers too. So let me go back to Laura's really quick. So one thing to notice on these plans is there's oftentimes a surrender penalty on life insurance. Just like annuities, you usually have a surrender penalty for the first 10 years. So in this case, when Charles was paying for Laura, he didn't have full access to Laura's cash until year 11, right? Year one, there's a surrender penalty because this is an investment. If you try to take your money out, there could be fees. After the first 10 years, those fees go away. But let's say you have somebody that's doing business planning and they're going to need access to their cash much quicker. So we've got a small business owner. It's Fred Sanford. He and his son own a small business. They want to be able to take out money for their business in about 5 years. They want to add on to their business and they know it's going to be about $100,000 investment. So Fred is going to pay about $25,000 a year for the first 5 years into his life insurance policy, and then he wants to be able to take out money for his business. So what we're going to do is we're going to use a rider called the balance sheet rider. And this balance sheet rider, I really want it to be thought of as more of a waiver of surrender rider. What it does is it's going to waive all surrender fees, so that your client isn't going to have any surrender fees. They're going to have full access to their cash. So if you look with Fred's policy, he has that waiver of surrender or balance sheet rider, and he pays $25,000 for the first 5 years. Then in year 6, he's going to take out a loan for $110,000 to be able to reinvest in his business, maybe to buy some real estate or buy a new building, right? So he takes out $110,000. Then he's able to, if he chooses, to continue to fund that life insurance policy, maybe at just $10,000 for the next couple of years. Then when he gets to retirement, he also can access money in retirement. he'll be able to take out roughly $13,000 a year for the rest of his life in retirement. So you can see how it could be used for a small business to not only put money away and help that small business uh, purchase obviously a new property or something, whatever Fred's needing at the time, maybe new machine equipment. But then it also can be used again to help supplement retirement. So hopefully that gets you thinking with some of the potential clients that you could use an IUL for. The big thing to take away is this is a very flexible product that's going to be there to meet your clients' needs, whether they get sick, they need that umbrella, or whether they need help in their retirement, college funding, or business planning. So with that, I think I'm going to make it right on time, and I'll pass it back over to you, Shaquita.
Hi, everyone. I just want to thank you guys. Thank you, Sam and Justin and Nancy, for your notes, for joining us today for our webinar. I also want to let everybody know to join Nancy and Eric and all of us next week on Friday, the 27th, at our At Work Network event at the Safety Harbor Spa and Resort at 12:30. And if you would like any more information regarding National Life Group or our event next week, please give our office a call at 800-662-5080. And again, thank you all, and everybody have a great weekend.